Okay, so hi everybody. Welcome back after lunch. This is session 3B. It's evaluating policy and macroeconomic issues. And we have three very interesting presentations for today. First up will be, I'll introduce everybody first. Adrian Hurley, who's an economist at the Department of Public Expenditure Reform and is a member of IGEES, the Irish Government Economic Evaluation Service, will be first up. And he will be looking or providing an analysis of the distribution of enterprise supports. Following on from that, we have Eoin Corrigan from UCD. He's a final year PhD candidate there, and he's currently at the Department of Housing, Local Government and Heritage. And Eoin will be providing a decomposition approach to exploring the decline of homeownership in Ireland. And then finally, we have Mr. Niall O'Donnell, who is formerly of Enterprise Ireland and is now an independent strategy advisor. He blogs at joinupthedots.com. And Niall will be providing a comparison of Ireland's absolute price levels to EU average using Eurostat data. So the way we will do this is everyone will have a 20-minute slot. So we will have three presentations of 15 minutes. And then there will be 4 or 5 minutes or so for question and answers, specifically dealing with the presentation that you will have just seen. So we will begin with Adrian, and you have 15 minutes starting from now, thereabouts. Good luck.
Very good, thanks Tom. I'll just share my screen here. Okay, can you see that?
Yeah, we can see that.
Perfect. So thanks, Tom. So, as Tom said, my name is Adrian Hurley and I'm an economist in the Department of Public Expenditure. And delighted to be given the opportunity to show our paper today at the NERI conference. And the title of our paper is an analysis of the distribution of enterprise supports. Just from the outset, just like to say that this is still a draft paper. So the findings and the content of the presentation are all preliminary. So what are we trying to find out and why is this important? So first of all, this paper focuses on the Department of Enterprise, Trade and Employment. And this department, it focuses on the years 2015 to 2020. This department between the years 2015 and 2019 had an annual budget of an average of 850 million. And over the last couple of years in response to COVID, this has increased to over $1 billion. So again, there's a lot of money going to this department. So it's important to understand where this money is going in the economy. When the department gets its money, it allocates it across various different enterprise agencies, such as Enterprise Ireland, IDA Ireland, and the local enterprise offices. Now, there is other enterprise agencies, such as Intertrade Ireland, who are in the department, but they're not part of this study as they were unable to fulfill the data request for the study. So most people won't be familiar with these enterprise agencies. So Enterprise Ireland primarily focus on domestic Irish enterprises who are looking to export and enter global markets. IDA Ireland focus on attracting inward investment into Ireland, and then local enterprise offices are a first-stop shop for many startup enterprises in the country. So these enterprise agencies, they provide a various number of supports, and through these supports then they filter out into the economy to the firm level. So this study really wants to understand who that firm is, and it's a high-level descriptive analysis. So it's not an evaluation or anything, it's just a high-level descriptive analysis of who that firm is who's receiving support. And we do that at a firm level, so we look at firm size and the ownership of the firm. We do it at a regional level, at the county level, and then also at the sectoral level. Now, it's important to emphasize that also across other departments, there's other enterprise agencies such as Údarás na Gaeltachta, Fáilte Ireland, and so forth, who provide enterprise supports, but they're not part of this study. This is primarily focused on the Department of Enterprise, Trade and Employment. In addition, it's also important to recognize that these supports are only one way that government can contribute to economic development. Other things such as skills development, taxation, labour market policy, infrastructure development, and so forth are also important. So in that context, it's important to realize that. So what are the objectives of the paper then? There's 5 main objectives. The first one is that we conduct a literature review of previous spending review papers in the area of the labour market and enterprise policy. The second objective is to look at who the enterprise agencies are and the supports that they provide. We then look at the distribution of the overall private enterprise base and the employment enterprise base. And then we also look at the distribution of the the agency clients across the firm level, sector level, and regional level. The fourth objective then is the main part of the paper. We look at the distribution of the enterprise supports that the agencies deliver, and we compare that distribution then to the objective number 3 of the private enterprise-based distribution and also the agency client-based distribution, and see how they compare. And then the final objective is the first set of key findings. So support from the enterprise agencies. So first of all, on the left-hand side here, what you'll see is that the average annual payments that each enterprise agency made through the years 2015 to 2020. And as you can see, the scale of the enterprise agencies differ. So you go from Enterprise Ireland making 176 million euros worth of payments every year, down to the LEOs or the local enterprise offices who are making 12 million per year, 2015 to 2020. So the scale of these enterprise agencies differ, and that's important to understand. The main supports then that they provide, so the main supports provided by IDA Ireland are the or D&I support. So this is support to their clients if they're carrying out research and development activity. And again, as we know, there's risk involved with this with research and development, and therefore this support is to ensure that there's no underinvestment in this important area, and it's to burden the risk. And then also the property program. So the property program constitutes 33% of IDA's expenditure, and the property program is to ensure that there's a supply of properties across Ireland that is readily available for FDI to move into if the opportunity arises. The main supports then for Enterprise Ireland are the Seed and Venture Capital Fund. So this is a fund that is targeted at early stage startups in Ireland. As we know, many of these are risky investments, therefore capital can be a problem for them at times. So Enterprise Ireland counteract that. And also company development. So these are tailored supports by Enterprise Ireland for their clients who are looking to expand. In relation to the local enterprise offices, then the two main supports for them is a business expansion grant, which constitutes 48% of their payments. And this is for businesses after 18 months who are looking to expand. And the timing grant, 41%, that is for businesses who are within their first 18 months support. So they're the main supports of each of the agencies. So a little bit about the client agents then. There's over 11,000 firms who have been a client of the selected enterprise agencies over the years 2015 to 2020. Just over around 5,000 of these are in the LEOs, just under 5,000 are Enterprise Ireland, and then just over 1,500 clients for IDA. Overall, client enterprises are bigger in size relative to the overall enterprise base. So for example, 14% of agency clients are either medium or large enterprise, compared to only 1% of the overall private enterprise base. And of course, this differs then across agencies, where the LEOs are mainly focused on micro enterprises, while if you look at someone like the IDA, 48% of their enterprises are either medium or large enterprise. At a regional level then, the distribution of the agency clients when taken together mirrors the distribution of the overall enterprise base. So we look at how the clients together are distributed, and we compare that to the overall enterprise base. And what you'll see is somewhere like Dublin has 34% of all clients, somewhere like Cork has 10%, Galway and Limerick 4%, and then the rest of the counties are between 1% and 3% of the agency clients. However, again, this differs when we look at it at an agency level, where you look at, and especially in Dublin, if you look at IDA, 40% of IDA clients are in Dublin, and 55% of Enterprise Ireland clients are in Dublin, while there's a less amount then of LEO clients in Dublin relative to the private enterprise base. In a sectoral level then, manufacturing is the main sector that the agency clients are in, with 40% of clients in the manufacturing sector, and other sectors that are prominent are in information and communications and finance and insurance. Within manufacturing then, Enterprise Ireland have a focus on the food and drink sector and also the metals sector. For IDA, the main clients are in the manufacturing. The other manufacturing, what's driving that under other manufacturing is medical devices. It's classified as other manufacturing, and then also the pharmaceutical industry. And what you'll see with these sectoral industries that they focus on, previous research has found that these are the sectors, especially information and communications and finance and insurance, these sectors are high paid jobs. And then also if you look at manufacturing, this is where the high gross value added is. So it mightn't fully reflect the overall sectoral distribution of the Irish economy, but it does concentrate on the areas of high paid jobs and also high gross value added. Okay, so now we look at the distribution of the supports, which is the main part of the paper. And it's important to, I suppose, emphasize in the paper, we look at payments and approvals. So basically an approval is a commitment to support a client at a future date, and then the payment is actually the drawdown of the utilization of that support. However, for today's purposes, just because of time, we're just going to focus on the actual payments. So the first level of distribution that we look at is at the firm level. So we look at this on the left-hand side, we have firm size, and on the right-hand side, we have the ownership distribution. So if we concentrate on the left-hand side first, so this is the firm size. So what we have here is we have got the value of payments. So that's the actual quantity of money that that is going to each firm size in the blue. And then at the green, we have the number of payments. So that is the number of enterprises getting support in each of these size categories. And then we compare that to the red dot here, which is the agency client distribution across each firm size, and also the yellow dot, which is the private enterprise distribution across each firm size. So if we concentrate on the blue bars here first, the value of payments, what you'll see is that this increases with firm size. So a large proportion of the value of payment is going to, just over 30% is going to large enterprises. And of course, this is a result that we would expect, because when you think about it, the larger the business is, the bigger the project they're going to be taking part in, and therefore the more money they're going to need. So if you think of an IDA client taking part in a research and development project, and compare that to a local enterprise office client at the micro level who's just starting up, that scale is going to be different. So this is a result that you would expect to see. However, then if you look at the number of payments, the green bar, then you get the reverse relationship. And again, this is going to be a result that you would expect to see, because if you look at the distribution, the red dot of the client, the agency client distribution, what you see is there's more enterprises in this micro category, and there's more in small relative to medium and down. So you can see that the distribution of the payments is similar to the actual distribution of the number of clients within each size category. Now, for most of them, they are very similar. If you compare the number of payments to the distribution of the agency client base, it is very similar. However, the biggest gap does appear in the micro. So over 60% of client firms are micro. However, just over 40% of payments are going to that area. So that's the biggest differential comes at the micro level. So on the right-hand side, then if we look at the ownership distribution of enterprise support, and we look at, is it an Irish owned firm or a non-Irish owned firm? And again, what we have here in the blue bar is the value of payments. So the quantity, that the actual value, monetary value of it. The green bar then is the number of payments, so the number of firms within that categorization getting support. And then the red one is the agency client distribution. So again, what you'll see if we look at the agency client distribution, close to 85% of all firms who are a client of IDA or LEOS or Enterprise Ireland are Irish-owned firms, and then just close to 15% are non-Irish. So what we see, if we look at the value, first of all, what we see in the value terms is that close to 60% of all payments in value terms, monetary terms, is going to an Irish-owned firm, and then just over 40% is going to a non-Irish firm. However, the differential, if we look at the number of payments, is quite significant. So close to 90% of firms who receive a payment are Irish, compared to 10% who are non-Irish. So again, why is the differential between the number and the value quite different? Well, a lot of these non-Irish are made up by IDA clients. So they're significantly, we're talking about IDA really here, and the Irish are going to be EI and LEOs. And if you think about it again, if the IDA clients are a lot bigger in size, well, then that makes sense that they're going to be receiving a bigger share of or bigger payment per firm. So if you look at the average payment that an Irish firm gets, it's 23,000 euros, and compare that to the average payment of a non-Irish firm is 150,000 euros. So whilst they only make up 10% of the actual overall number of firms getting a payment, non-Irish, they're constituting up to over 40% of the actual value. So the payment per firm is bigger for non-Irish firms. And again, that's been driven because the clients are bigger with the IDA. So that's the firm level. Now then at the regional level. So what we do, first of all, is we look at it as, this is all clients together. So the LEOs, the IDA, and the EI. And what you see here is, this is the distribution, these are percentages, and this is the payment value distribution. So this is taking all the values and how's that distributed across the economy. And what you see when you take all the clients together, what you see is that this distribution that you see is very similar to how the overall enterprise base in Ireland is distributed and how the overall client enterprise base in Ireland is distributed. And in fact, actually how the overall population in Ireland is distributed. So you see here 32% of all payments from all the clients goes to Dublin, 13% is going to Cork, 6% going to Limerick, 8% Galway, 4% Waterford, and then the rest of all the other counties are between 1% and 3%. So as I said, when you look at it overall, it mirrors quite similar to the overall private enterprise-based distribution and how the overall client enterprise-based distribution.
Just 2 minutes, Adrian.
Oh, perfect. Okay, so basically, okay, I better speed up here. When this is the regional. So when you look at it then at a county, at an agency level, what you see is quite a few differences. So for Enterprise Ireland, what you'll see is that there's a strong concentration in Dublin. Okay, and also there's a strong concentration of payments that go to their overseas clients. Okay, so their overseas clients are representing 1%. However, they represent 9% of their payments. For the IDA, what you'll see is although 55% of IDA, or sorry, although 55% of IDA clients are in Dublin, just 21% of payments are going there. So there's a bigger share going to across the other counties, such as Cork, Limerick, Galway, Tipperary, and Waterford. They receive a higher percentage of payments relative to the amount of clients that are there. The LEOs then, they actually have a similar distribution of their clients, of their payments, is a similar distribution to how their clients are distributed. So very quickly then in the sectoral level, what we're seeing is a lot of payments across both agencies are going to manufacturing. Okay, then for IDA, the next biggest one is going to information and communications, and then finance and activities. For EI, finance and activities is above information and communications. It's these three sectors again that are the main sectors that are being supported. And then within manufacturing, what you'll see is the green bar here is the IDA, and that's other manufacturing. And again, that's been driven by medical devices. So that's the main one, that's close to 50%. And then just over 30% is going to chemicals and pharmaceuticals. However, for EI, the blue bar here, the majority is just under 50% is going to food and beverages. And then other ones are such as computer, electronic and optical and electrical equipment, and also machinery equipment. And again, for sectors, we're just focusing on EI and IDA because the LEOs didn't have the data to allow us to do it at this level. So very quickly then, just to recap, this paper looked at the distribution of enterprise supports from 3 enterprise agencies, and it focuses at a firm, regional and sectoral level. At a firm level, micro and Irish-owned enterprises receive the greatest percentage of supports in terms of the number of firms who receive a payment. However, medium and large firms receive a greater level of support in value terms. At the regional level, the distribution of the enterprise supports for most counties is similar to how the overall enterprise base is distributed and how the overall agency client base is distributed. However, as we said, this differs across agencies. At a sectoral level then, manufacturing receives the greatest level of support. EI has a strong focus on food products and beverages, while IDA focuses support on medical devices and pharmaceuticals. Other sectors of focus include information and communication and finance and insurance. So that wraps up my talk. Thanks for your time and happy to take any questions.
So much, Adrian. That was very, very interesting. I was a little bit surprised that the Enterprise Ireland funding for finance was as high as it was. I wasn't anticipating that. Is that a more recent development, or has finance always been such a large component?
Yeah, well, we looked at it over time, and we looked at it only over the data that we received from the enterprise agency was for the years 2015 to 2020, so we're kind of limited in looking at a long trend. But over those years, there wasn't any change in the composition, a significant change in the composition of the sectors that they're supporting. As I said, you probably would obviously need a longer data set, but for our data, we just got the years 2015 to 2020.
Have you been able to do an analysis of the impact of the funding within each of the 3 agencies in terms of, is there sectoral differences in terms of what subsequently happens in terms of gross value added in the company relative to the amount of supports that are given, or have you discovered kind of any discernible trends that might be there?
Unfortunately, given the time scale, so basically this is a paper that we just had a couple of months to do, and it's also anonymized data, so it's a very high level. So yeah, so it's we don't have we don't understand what company it's going to, or as you said, we don't have any pre versus post impacts or anything like that to understand what has happened with that company. So yeah, it's a very high level descriptive analysis. And with the data that we have, I'd be unable to do that just because it is anonymized. So we don't actually know who the actual company behind it is.
Gotcha. I was very interested to see the regional breakdown as well, and how it cleaves so closely to population as well by county. A few counties maybe doing below average and others doing better than average, which of course is what you would expect. Does anyone else have any questions for Adrian? If not, time requires me to move on to Eoin, but there might be a little bit of time at the end to gather some more questions for Adrian. So for now, Adrian, I'm going to pass over to Eoin. And Eoin, of course, is going to be talking about, well, he's going to be exploring the decline of home ownership in Ireland. So Eoin, take about 15 minutes or so, and hopefully then we'll have a bit of time for questions at the end. Thanks very much.
Okay, thanks, Tom. There we go. All right. Yeah, all right. So a paper on looking at home ownership in Ireland and a decomposition approach. There we go. So as I imagine most of you know, the proportion of home owning households in Ireland has seen a huge fall from a peak of just under 80% in the early 90s down to just over 2/3 in 2016. And usually these kinds of tenure shifts happen slowly, but this has not been the case in Ireland. It's an especially severe decline, second, I think, only to New Zealand. And this has taken place in the context of a society which largely regards home ownership as superior. It's a positional good, symbol of success. There's autonomy and security from eviction. Home ownership insulates homeowners from rental market inflation. It's seen as an investment as well, which can appreciate and serve as collateral, and it's associated with other benefits. And this rate of decline has been asymmetric across age cohorts. You can see in this graph here that along the leftmost side, for all ages, it's occurred, as I said, quite severe, but particularly severe for age groups aged under 40. So under 25, 25 to 29, 30 to 34 in particular, have seen huge falls from, and this is only from 2006 to 2016, so over a 10-year period. So there's, why am I talking about this in a labour market conference? Because some of the theories as to why this happened are essential to the labour market. There is the idea that across the Western world, there's been a decline in relative earnings among younger cohorts and the increased incidence of precarious labour market conditions, and that could be feeding into this tenure shift. There are, of course, a flurry of other theories as well. So in Ireland, it could be due to secular social policy shifts when generous subsidies were withdrawn in the 1980s, the home ownership subsidies. There was, of course, the 2008 global downturn. There have been relative movements in the user cost of housing and rents over recent decades in Ireland and elsewhere. There's, of course, the question of affordability and the rapid increase in market rents in recent years. There is the argument that there are altered preferences amongst younger people and households that would prefer access rather than ownership, and attitudinally as well, that maybe there was a scarring effect, that the younger households observed negative equity and foreclosure, etc., and decided maybe that home ownership isn't as attractive as it was for previous generations. Immigration is in the mix, and then of course there are credit markets that perhaps the banks are more risk averse post the 2008 crisis, and we have macroprudential regulation as well. So there's a blizzard of theories here. What's actually going on? There isn't a lot published on in Ireland. So looking at the labour market specifically, using some OECD data sets, we can see that the incidence of involuntary part-time workers grew particularly for these two age cohorts, 15 to 24 in red and 25 to 54 in blue, after the global crisis. Grew considerably and hasn't recovered yet, especially for the 15 to 24-year-olds. And then looking at mean disposable income, again over the same period, more or less, from 2007, For all age cohorts, disposable income fairly collapsed really, but has recovered by 2017. However, the rate of recovery for 26 to 40-year-olds has been, haven't done quite as well as the rest of society. So falling back in income terms. So there's some evidence here to suggest that yes, there is a labour market component to this decline in home ownership. So why might this matter? Well, reduced home ownership could have a major impact on household costs because of more households renting in an expensive rental market. And there's also fiscal implications as government incentives and subsidies are being deployed increasingly, and I don't think that's going to halt anytime soon. For most Irish households, primary asset is the family home, so home ownership and tenure shifts has big implications for the wealth distribution. And there's of course the question of intergenerational equality of younger renters paying rents to older landlords. We've also looked in the past at attitudes to home ownership to find out whether that point about attitudinal shifts has any traction. We found that 87% of non-homeowners aged 25 to 49 want to become homeowners. And interestingly, we didn't find any statistically significant difference between Irish and non-Irish when we conducted this survey just a couple of years ago. So if the demand for home ownership is high, why is the rate of home ownership declining among adults aged 40 and under? And what insights can a blind Oaxaca decomposition provide concerning the shift? So looking at some of the descriptors, the data set is the CSO sub-data set, which is very rich, as I'm sure many of you know. I was looking at the 2007 and 2018 waves. One drawback with SOC and many surveys of this nature is that there's household level aggregation. So there's variable conflation amongst members of the household in terms of, for instance, maximum educational attainment. And we also have nested generations. Living in households, so increasingly younger adults living with their parents, and so pseudo households and concealed households, and these are often non-income sharing, especially in the rental sector when we have adults living together. So, are they really households? And for the purposes of this study, I conducted the analysis at two levels of observation: first at households, but also at the individual level. So. Here we are in Silk. We can see that collapse, that tenure shift collapse, as I mentioned earlier, from 2007 at the household level. 63% of households were homeowners, those households aged 40 or less, and that falls to 47% just over 10 years later. And at the individual level, similar numbers. So looking at some of the household characteristics, and the columns I'd like you to focus on here are on the extreme right, we have private renters, households aged 40 or less, and then in the center, homeowner households aged 40 or less. And there are big differences between these groups. Far more renters are in the lower income quartiles than homeowners. Asterisk means I didn't have enough observations to report a result, so you can read an asterisk as very few. So a lot more private renters in the lower income quartiles. A lot more non-Irish citizens are private renters. Only 58% of renters were in 2007 were Irish citizens. A lot more private renters reported an incapacity to meet unexpected financial expenses. There were composition differences between homeowners and renters, far more families, as one might expect, in 2007. And non-permanent contracts were far more prevalent among private renters in 2007, and a big education difference, far more graduates and postgraduates among renters in 2007. By 2018, some of these differences were no longer apparent. For instance, homeowner households aged 40 or less have caught up and in fact exceeded the educational attainment of private renter households. But there was still, and also there was convergence in terms of composition, family composition. There were a lot more renter households with children approaching the numbers amongst homeowners. Far less, however, public sector workers in the rental sector compared to homeowners in 2018, and considerably more part-time workers amongst the private renter cohort in 2018 than homeowners. So looking at the decomposition, this is a blind Oaxaca approach, so running two sets of decompositions. Firstly, as I mentioned, at the household level, then at the individual level. I use the Hurley procedure because this is a logistic model, because the outcome is either homeowner or non-homeowner. At the household level of the unit of observation, maximum age less than or equal to 40, and comparing homeowners to market renters, excluding social renters. At the individual level, age 25 to 40, comparing homeowners on the one hand, and then renters or working adult children and their spouses living in the parental home. So how does the Blinder-Oaxaca decomposition work? Well, the goal is to identify and quantify the separate contributions of differences in characteristics and endowments across the 2007 and 2018 cohorts. So this is a stylistic simplified graph. We've got two regression lines here. The red line is the 2007 equation. Along the x-axis, we have a vector of determinants, so endowments such as income level, education, family composition level, and so on. And then on the y-axis is the probability of attaining home ownership. So what we can see here is this broken red line here is the gap, the home ownership gap between the 2018 cohort, who have a home probability over here of home ownership about 40%, and then the 2017 cohort of a probability of home ownership over here. So this broken red line is the gap. The decomposition is breaking this down. What it's effectively doing is taking the mean difference in endowments between the 2018 and 2007 group and weighting that by the coefficients, so the slope of the regression line, so the coefficients of the reference group. The reference group could either be the 2018 group or the 2007 cohort. So this is on the indexation problem in Blinder-Oaxaca analysis, which I'll come back to in a moment. So hopefully that's clear. The variables I've used for this analysis, the usual household characteristics, income, age, children, non-Irish, high density location, also labour market variables, as I mentioned, so whether self-employed, non-permanent contract, part-time worker, or public sector, and then financial strain variables, so whether the household is in debt, whether there's non-housing debt, whether that debt is a burden, and whether the household reports a capacity to meet unexpected financial expenses. Here are the broad level results. I used five models analyzing at the individual level, 5 more models at the household level, but I'll focus on the individuals for now. You can see that the probability of home ownership has dropped across all models from 0.63 down to 0.44. That's a difference of 0.188, which is pretty big. And you can see how well are these models explaining that difference. So what proportion of that 0.18 or 19 rather is explained by the Blinder-Oaxaca analysis, and it varies across models. It's particularly low for the 2018 model. Other models do quite well, explaining about half of the difference. Looking at the breaking this down, the decomposition into the individual level variables. So how are the individual variables contributing to this difference? Again, we're looking at 5 models across the top. What I've highlighted here are those variables which are statistically significant across the models. So age is working, and the sign there's negative, which means it's closing the gap as households get older and individuals get older. The probability of home ownership increases, which is one might expect. And non-housing debt is significant across all of the models, as is non-citizenship. And then for the 2018 model, children and high density become statistically significant, but is not significant amongst the 2007 models. So what's my interpretation? Well, as I said, I did it at individual household level, these analyses. I haven't shown the household level results, but individual level results are far more consistent. The sign and magnitude of the coefficients are across the 5 specifications. Were pretty consistent. I think that, as I showed you I used 2007 and also 2018 reference groups, that indexation issue. Personally, I think the 2018 individual model makes more sense. It's less distant temporarily from our own situation. As I said, the probability of home ownership drops by about 1/3 in 11 years for these individuals aged 40 or less. Importantly, income and labour market security variables are not significant in any of the 5 models. And I think that's really interesting, and there's a real contribution to the international and national literature here, because often income differences, a declining income share, labour market security, precariat type arguments are frequently mentioned as explaining the gender shift, but not so according to this analysis at least. The largest positive factor contributing to the differential is non-citizenship. So that accounts for about 14% of the 0.19 gap in probability. Non-housing debt, so credit cards, car loans, and so on, is also significant, accounting for 12% of the 1.188 gap. And in the 2018 and pooled models, the child variable accounts for 4% of the gap in probability. And I think that's worrying from a social policy perspective, because it seems to be the case that, unlike in 2007, in 2018, households with children are less likely to become homeowners. And maybe it's the case that banks are pricing children in terms of in terms of the maximum amount of loans being afforded to potential homeowners. But in any event, I mean, if we're in favor of home ownership, public policy is in favor of home ownership, it ought to be particularly in favor of home ownership for children, I would imagine. Also, the high density variable is significant in 2018, which wasn't the case in 2007. High density being, highly urbanized areas, which suggests, and I think it probably is in tune with our intuition, that affordability in urban areas has become particularly difficult. So, what are my conclusions here? Well, decomposition offers only a partial explanation of what's going on. The labour market, although clearly is intertwined with housing markets, doesn't appear to be a source of the tenure shift. So declining income shares and precariat, they may be out there, but they don't seem to explain the tenure shift. Given that non-citizens want to become homeowners, we know that from previous surveys, why is the non-citizenship variable so salient and significant? Well, it seems to be, perhaps the case that there are market frictions in place or other constraints, and that seems to be something that is important and should be looked at. And as I said, the children of renting households, children of generation rents, I mean, that's from the social policy perspective, that's worrying, I would think. As I mentioned, blind or Oaxaca analyses of this type break things down into an explained component and an unexplained component. These analyses don't necessarily, however, deepen our understanding of the mechanisms underlying the relationship between factors and outcomes. So, and I think that's important to note that in the context of this study, I couldn't directly observe any variables related to access to mortgage credit. So I think it's strongly likely that changes to credit market conditions arising from the 2015 introduction of the macroprudential regulation are a factor here. And I know the central bank is looking again as it was reviewing the macroprudential regulations. And some final comments was I think the tenure shift is obviously very, very interesting, and social policy wise, there are huge implications. I'm not advocating policies intended to reverse the tenure shift. I think there are big macroeconomic risks in that. I think as a society, we're anchored in kind of expectations of levels of 80% of home ownership as being natural. But to get there would require huge subsidies, which are very expensive. There's a lot of deadweight risk and they're potentially regressive. So this tenureship is perhaps unlikely to be temporary, and so perhaps we should focus on market dynamics such as interoccupation and providing stable and affordable alternatives to home ownership. And that's the end of my presentation. Thank you very much.
Thanks very much, Eoin. Certainly a lot to take in there. You might put up that that last slide again, the one with the conclusion slide, the last one with text, just for a second, because I was interested. I was anticipating. I mean, a lot of the analysis is that ownership has a lot of benefits over renting. So I was somewhat surprised then by your second last bullet point, and maybe you might kind of talk about that a little bit more. You say you don't advocate for policies intended to reverse the tenure shift, which I think is interesting. I don't necessarily disagree with you, but maybe you might kind of tease that out a little bit for us.
Sure, and one of the questions I'm sometimes asked when I talk about this issue and present this paper is, what as economists can we say the level of home ownership ought to be? Can we make any positive statements about that other than nominal or normative statements? And I think amongst housing economists, at least the tradition is to say that we ought to have a level of home ownership which is robust to the macroeconomic cycle. What we don't want to do is to put households and the financial sector, and by extension the wider economy, into trouble when we have downturns which are unpredictable in terms of when they occur and their magnitude. So I think that's an important point. But also I think, as I mentioned, there's that anchoring issue. I think in public discourse, it's almost implicit that we ought to be back to where we were 15 years ago, 20 years ago, but we only got there through a huge raft of subsidies that were very expensive and of huge opportunity costs. So I think Yeah, you know, my own personal view, at political level, and just in the commentariat, I don't think we've confronted the fact that if we really want to push home ownership levels up to where they were, there were big risks, even for the banking sector or for the state, but also the type of policy mechanisms we usually use to do that have these risks of being, you know, potentially regressive and having huge deadweight costs. So I think Help to Buy, for instance, as a massive deadweight you know, aspect to it.
Indeed, it does. I mean, that's pretty clear. And just to kind of take that a little bit further, then, would you go? I mean, looking at it as economists, we tend to be pretty hostile to tax expenditures in general, and obviously there are these advantages which are artificially created, to benefit home ownership and buying a house versus renting and so forth. And obviously there's issues in terms of the security that renters have. So do you think that we should be looking potentially at removing all of those tax breaks or tax advantages associated with home ownership? Is the answer more about improving the quality of renting through better regulation, perhaps? I mean, maybe you might have some thoughts on that.
Yeah. Personally, although you know, this is just opinion and not grounded in any kind of, you know, data or whatever. But I think, you know, the local property tax, you know, obviously, you know, property tax, and you know, it's very controversial. But it seems like if older generations are genuinely serious about caring for younger generations and access to home ownership, then these kinds of tax changes you're mentioning are very important. Capital gains, non-taxation, principal family home, mortgage deductibility, and so on. They all skew the pitch in favor of homeowners, and their you know, the distribution of these tax advantages is obviously, you know, towards the upper half of the income distribution. So I think yeah, I think it's something that ought to be looked at. It's just finding, I think, the political economy space, because these issues are so controversial. But yeah, I agree.
Yeah, and I just have one question from Kieran Nugent, and he's asking, have you looked at earnings rather than disposable income related to home ownership? And related to that, is that household disposable income that you're looking at? And he adds that he knows disposable income includes things like house payments and so forth.
Yeah. So I've used disposable income, although that can be difficult in SUC because of, you know, this household aggregation, as I mentioned, at the household observation level of disposable income. And so what I had to do was unpick all of that, go through each household one by one, and begin to figure out, you know, where do we have nested households and so on, and if so, you know, how do we treat household income? But yeah, I think, and also I haven't included any social housing, whether it's social housing traditionally or social housing with a subsidy like HAP or rent supplement. So, well, I know rent supplement is different, but there are no housing subsidies in there. Those households have been excluded from the analysis. So it's fairly pure in terms of disposable income.
Very good. Okay, Eoin, we'll have to leave it at that for now. Perhaps there'll be an opportunity at the end for additional questions. So I'm going to move on to our third presentation, which is from Niall O'Donnell, and Niall is going to be discussing price level comparisons. And Niall, you have about 15 minutes, and then we'll have a bit of time for Q&A at the end.
Okay, thank you very much, Tom, and good afternoon, everybody. Thank you to the Institute for the opportunity to contribute. I'm going to be talking about Ireland and comparing price levels in Ireland with EU averages using Eurostat data and the National Competitiveness and Productivity Council analysis. So the summary is, as I think everyone would expect, is that Ireland is a high cost, rising slowly price levels. This is the National Competitiveness Council's own conclusion. We're a very expensive place for businesses to operate in and for individuals and households to live in, with overall GDP price levels nearly 20% higher than the European 27 average, fifth highest, and actual individual consumption price levels nearly 40% higher, that's fourth highest. And there's a range of internal factors and actors appear to be driving this differential. And there's a need for, question is there a need for a system level strategy aimed at relative price levels as well as price growth rates? So the reflection is on how expensive is Ireland, why does it matter, and what is to be done?
Sorry, Niall, do you want to share your screen?
I thought it was share my screen. Okay.
I'm not seeing it up.
Okay. Sorry about that.
Just the green button at the bottom, third from the right.
Okay. Sorry. Apologies.
If you have any difficulty, I can share for you, Neil.
Apologies. I thought I had shared this.
Not
okay.
at all.
Okay.
Fantastic.
That shared?
Yes, it is. Perfect.
Okay, great. Apologies about that. Okay, so we're just going to talk about a number of questions around how expensive is Ireland. And if I just, sorry. Is that okay still? Still been shared?
Yeah,
yes, it is. Yes, it is.
Okay.
Perfect.
So, okay, so basically, if we are looking at a number of key questions and we're using the data from Eurostat on price levels and obviously the National Competitors Council's own analysis of these particular issues. So this is the data that we're looking at, which is basically what we're looking at here is the Eurozone, the European Union 27 minus the UK in 2020. They are the base of 100. And what we're looking at here is Ireland and the UK's differential between that 100 in 2011 for Ireland, 2020 for Ireland, and UK 2020. So what that shows is that GDP price levels are over 17% Ireland compared to EU 27 in 2020. And if you look at the left-hand side of the slide, you'll see that most costs from a business point of view are actually relatively close enough to the European average. I should say that the business distinction between business and individuals, which is in the next slide, is my own distinction. Eurostat do not do that, just make that distinction. But I think from an analysis point of view, I think it's useful to make. So for example, from a business point of view, gross domestic capital formation is close enough to the European average. If you look at the right-hand part of the slide, again, total goods, particularly durables and capital goods, are close enough to the European average. It's when you come to services, total services, 45% over the European average, that's where you start to get significant difference. There isn't any business services, so I've taken as a proxy consumer services, again, significantly high, and government services, 33% higher. So just moving on then to individual related price levels, and this is where we see significant differences. So for individuals and households, actual individual consumption is nearly 40% higher than the European average. And that ranges from a number of areas such as food and clothing and footwear, which are close enough to the European average, to significant areas such as housing, health, education, restaurants and hotels, which are significantly above that. And of course, consumer services, very high compared to the European average, nearly 60%. So this basically is summarized here, where we're looking at GDP overall price levels at over 17%, and then services particularly high, and goods only 10% higher. From a business point of view, they overall generally close to the European levels, but however, key costs such as credit, insurance, and legal are quite problematic. And then if you look at the impacts of COVID and Brexit-related costs, that's now adding significantly to various costs. And for the tourism industry, they would see their price levels as being relatively high compared to the European average. For individuals, the story is significantly different, where you're seeing average individual consumption at 38% higher, and then as we said already, particular items particularly high. The National Competitors Council looks at this in a number of ways. It looks at credit, which is particularly high, over 2/3 higher than the European average. Transport, while close enough in price terms to the European average, actual real congestion costs are very high. Premises, both rental and buying and building rather, are very high particularly in Dublin. And then legal costs are actually quite high compared to say the European average, Denmark being 5%, Ireland being nearly 20%. And then labour costs are broadly in line with the Eurozone average, lower than key European competitors, but higher than the UK. And then obviously, as we all know, individual related areas such as accommodation is extremely high, grown a lot, considerably higher over the last 4 years. Childcare exceptionally high, and then income taxation is comparatively low in Ireland for individuals and families on average, and high incomes, but with high marginal rates for some earners, relative to the EU averages and to the UK. So why is this the situation? Well, if we look at, first of all, the overall area, we're in a single currency zone. So you'd expect that actually price levels would approximate the Eurozone average. And actually, if you go back to the mid-90s, we were below that, and we actually did start to converge on the Eurozone average right into 99 and into on. But we kept growing, and through into the Celtic Tiger years, where we actually reached the early 20s in terms of difference between the Eurozone. We fell back a bit in the crash, and now we're back to about 10% higher than the Eurozone average. A bit more approximate when we compare the UK with Irish levels. So if you look at individual reasons that have been advocated for higher cost levels, price levels in Ireland compared to other countries, particularly the European Union 27, there's a range of factors. So location and scale, we actually are a small population on an island, so it does cost more to get things here. The smaller scale of Ireland's market has been suggested in a number of areas, such as goods and credit, and infrastructure markets. The question has arisen, is it Ireland too small for competition? Is this having an impact on price levels? Market power and competition, or rather lack of it, use of market power by suppliers, bank credit, insurers. European Union is already investigating this area, and in some questions have been raised about larger retailers. Bank credit, of course, exit of your Ulster Bank is significantly going to be challenging in terms of cost of credit. More unfocused regulation, insurances and higher court awards, as we see today from the Irish Times. The actual court awards now come down because of the new guidelines, but before that were exceptionally high. Use of market power by large companies to bid for scarce resources, office rentals, price of software, skilled staff, and so on. And of course, barriers to entry in key professional services such as legal. Priority to rent and land as factors of production, no implementation of the Kenny land sales report and the cap on development land versus agricultural land, few downward rent clauses, and so on. Lack of coordination by government and other actors in, say, for example, the insurance area. But of course, as has been already pointed out in the press, there are major risks by Colin McCarthy. There are major risks and costs to the community underwriting every downside that occurs, and we've already experienced property banking as an example of that, which didn't turn out too well. So less relative productivity in key areas. So the Council for Competitiveness brings our attention to construction, transport and logistics, accommodation services has been relatively less productive than other countries, and the questions arises in professional services, perhaps even in government services as well. Clearly, in certain sectors, there might be higher labour negotiating power that has an impact, in utilities perhaps, and then of course, higher indirect taxation from a policy point of view, perhaps required in alcohol and cars. Also, obviously, laterally, the whole Brexit is now starting to drive up costs. So does it matter? Well, for businesses directly, exporting at over with nearly a fifth higher cost than other countries is significantly adding to cost. It requires other things, higher prices, and therefore lower sales, output, employment, wages and profits. Makes it much more difficult for SMEs and lower margin sectors to export. And actually with lower profits, there's less investment, and so a negative cycle of undercapitalization and lower real productivity, which is very significant in many parts of the Irish economy, and credit costs, higher credit costs adds to this. There is, of course, a small number of larger and multinational operations who've got internal economies of scale, who are embedded in the corporate, global corporate value chains, that they can be less impacted. From an individual point of view, of course, for individuals and families who are paying much higher than EU average prices, they're having much lower real income as they experience this. There's major pressure on budgets for food, childcare and housing, and has already been put out earlier. There's actually a significant impact for lower wage workers compared to their access to goods and services compared to other countries. And of course, this reality is reflected in the recent Eurostat analysis of household living standards using this actual individual consumption AIC data that we've already referred to. And that's actually where we actually are in the middle, roughly, from a living standard point of view of the European 27, rather than the generally headline of, we're top of the league or whatever, near it. And then you could argue that actually Ireland's relatively low income taxation is seen as one way of trying to compensate for lower individual households for the exceptionally high consumption price levels. And of course, this has significant consequences of less investment in public services and equity, and brings its own challenges as well. So what's to be done? Well, what's been done now is there's significant focus on competitiveness and on price levels through the National Competitiveness and Productivity Council, which is a social partnership body. It's been playing a critical, indeed heroic role during particularly the property boom years in analysing and highlighting the need for action on important competitiveness issues. They have actually carried out a lot of analysis on this area. They point to the Harmonised Competitiveness Index as a key indicator of competitiveness. That actually does reflect both movements in prices as well as exchange rates. So it's a good indicator for competitiveness. And the council stresses the importance of 5 drivers such as credit, legal, insurance, and housing and childcare as being critical costs that need to be urgently addressed. What else might be needed? Well, the question arises, should we go to directly focus on the particular price levels, the general price levels that are actually that businesses face, for example, the GDP price level, and distinctly that individuals face, either the actual consumption one we talked about, individual consumption one, or indeed the CPI price levels. The benefit of such a focus, a more direct focus, is that's directly focusing on the price levels as areas for strategic action. The cost, of course, is that the system might have too many goals and may lose focus. If we are to adopt such an approach, what's the 3 or 5 drivers that will most impact on such businesses? The NCPC's 5 issues are clearly the most central, but there may be others. And then, of course, the policy toolkit required are all need to be pragmatically used in the key areas: competition, controls, coordination, taxation, community and state investment, and so on. Obviously, there's major challenges in such an approach. As the Council Competitiveness and Productivity itself says, these structural issues are long-standing, difficult issues for which there are no easy solutions. They may reflect resistance to change amongst entrenched interests and require concerted efforts at a political level. And also there are hard choices, as desirable policies such as carbon tax, higher living wages, sugar tax, and so on may increase actual price levels. This is not an argument against these particular policies, but they imply that there's a macroeconomic level impact that needs to be taken into account, and that implies other areas must reduce faster. And the composition, if you like, of the price levels and increases actually needs to be taken into account.
Just 2 minutes now.
As a small island, there's always going to be higher relative costs as a result of our island location. Global factors outside of our control will also influence us, and that implies a need for a focus on wider and greater real productivity growth if we're going to manage these whole areas. Thank you very much, and I look forward to any questions.
Thank you very much, Niall. That was certainly comprehensive and very valuable. There's a lot to ponder there, and again, I encourage people with their questions. So I agree with you in terms of AIC. It's something that's been pointed out many times to me in terms of a better measure of the actual standard of living in Ireland. And obviously we know the GDP is completely out of whack. I wonder, you pointed to credit, legal, insurance, housing, and childcare, and obviously the council is very much looking at those. Kieran Nugent in an earlier session pointed out that the Troika tried to get Ireland to do something in terms of legal costs, but was rebuffed by the government at the time. So I think you're right. I think the political economy issue here is very salient, and it's very difficult to take on entrenched interests when the benefits are very small, but across the economy,
diffused, yeah.
whereas the costs to going after an interest group, are such that they will fight tooth and nail to kind of protect. The housing and childcare, of course, are always kind of brought up in the Irish context. I'm particularly interested in the issue of tax at the moment. And you made the point that obviously if we continue to increase consumption taxes, and obviously, as you know, our excises are the highest in Europe, effectively, and of course, they would be regressive in nature too. But given that, the Commission on Taxation is now reviewing the entire system, and obviously, if, for example, the state were to intervene in housing to potentially, theoretically at least, bring down housing costs, obviously that's going to require more taxes. But if you're increasing consumption taxes, that's going to increase prices as well. So I'm wondering, Niall, do you have any thoughts as maybe to what the best kind of balance is in that? Like, what is the scope for policy change? What would you kind of advise policymakers?
Well, I think it does start with actually looking at what are the key drivers, and certain things we can control and certain things we can't. I think housing is obviously a very clear one, and clearly needs a very how to put it, very focused and energetic policy to actually deal with the very complex issues there. But for example, we've seen Rory Hearn, for example, of Maynooth, published recently a very interesting overall systematic approach. And whether you agree or disagree with that, it's that scale and that system level approach that actually is required as distinct from individual areas. But even in taxation, for example, my understanding the UK doesn't charge VAT on domestic housing, so it is charged here. So like it's actually looking at a number of broad areas, but having very detailed, robust, energetic policies to achieve. For example, the guidelines on insurance, they've now apparently started to bring down the level of core towards, which is very helpful. However, the length of time it took to put them in place was very significant. And if it takes us that long to actually get that particular policy in place, if everything else is going to be that long, we're very significant. So there is a question of, can we at a macro systematic level focus on a number of small key areas that make a big difference? And that, I think, is the biggest challenge. And it is a very, how would I put it, a very socially and politically challenging request. But that's if we are going to improve living standards, getting down price levels, or certainly reducing the rate of growth, absolutely is very significant, particularly in key areas such as housing, childcare, and so forth.
Yeah, no, I would certainly agree in terms of housing and childcare. And indeed, childcare is an interesting sector because it's one that doesn't work for the workers, it doesn't necessarily work for the businesses, and it certainly doesn't work for the parents. So it's a good example of a dysfunctional market that isn't working for anyone at the moment, and is another area alongside housing where fairly radical policy changes may be required. Obviously, there's some areas where it's very difficult for Ireland, credit being one. We do have a lack of competition. We're going to have less competition into the future. That's obviously a major problem for business. Do you have any kind of thoughts as to maybe what Ireland could do in that regard? Are there future sources of credit that could be tapped? Is there a European dimension to this?
Well, I think it is about increased competition, particularly, and there are certainly aspects in terms of access to European Investment Bank kind of funding and so on. But I think in the Irish scene, the credit unions, for example, there's aspects of them that could be actually strengthened. There's the German regional banking system, for example. I know there's been some work done on that already, but that certainly is one element of increasing banking competition. And again, being watchful, if you like, in terms of whether the two current larger commercial banks take over more and more of the system. I think that's a regulatory competition issue which also needs to be focused on.
Yeah, I agree, and I think it's interesting that the difference between the EU is more pronounced for services than for goods, because that might suggest that the transportation isn't a significant factor here, or at least not a dominant one.
Yeah, I think that's a really interesting one, and I think both for business, but also for consumer services. I think the data doesn't go into detail on it, but I think that's certainly one area that needs to be particularly looked at and focused on.
So we are running up against time. I have to present in the next session, which starts in just a couple of minutes, and Paul is chairing it. So I'd very much like to thank Adrian, Eoin, and Niall for very, very interesting presentations. We will put all three of them up on the NERI website with all of your permissions, of course, assuming you provide those permissions. And I'd like to thank you all. I found them very, very interesting, and just definitely much for me at least, and hopefully for the participants to reflect upon. So I will end this session now, and we will get ready for the next set of presentations. So thank you very much to you all.
Thank you.
Thank you.